You're starting to see a real shift in the housing market. I mean, Zillow stopped buying homes because they're worried about the housing market and they cannot sell the inventory of homes that they have. You're starting to see the market cool down. This is what realtors are saying. And you're starting to see an uptick in foreclosures. Now, this is where everybody's starting to get worried about a potential housing market crash. But this housing market crash isn't what you think. What's up, everybody? I am Jasprit Singh from theminorityMindset.com, where money minds rethink rich. A housing market crash would be if you see housing prices drop by at least 20%. If housing prices fall less than 20%, it's considered a correction. More than 20% and is considered a crash. Between 2020 and 2021, we saw one of the biggest booms in the housing market that we have seen in the history of our economy. It was like a perfect storm in the housing market. You had very low mortgage rates, you had very little supply of homes for sale, and you had everybody that wanted to buy a home and get a home with an office, that way they can work from home. We saw some of the lowest mortgage rates in the history of our economy because when this pandemic hit in 2020, the Federal Reserve Bank slashed interest rates again and again and again, and this brought mortgage rates to historic lows. So people wanted to take advantage of these cheap mortgages because now all of a sudden it was cheaper for you to go out and buy a home because your mortgage was cheaper. Then you had a very limited supply of homes available for sale because on one hand you had the foreclosure moratorium, which made it illegal for banks to foreclose on people even if they weren't paying their mortgages. And then you had the mortgage moratorium, which said that you don't have to pay your mortgages. So people weren't incentivized to sell their home because you could have essentially lived in your home mortgage free because you had some time to not pay your mortgage. The government said it was okay as long as you had a qualifying mortgage. Plus, it's harder for builders to build new homes because of all the supply chain issues. It's harder for builders to get their hands on materials, and when they do get their hands on materials, they have to pay more money, which means that now their costs are higher, which means that now it's going to cost more money to build a home, which means that you're going to have to pay more money. You might remember the whole lumber issue that was going on when we saw lumber prices skyrocket in 2021. And then you also had the labor issue. You're still seeing this today where builders are having a tough time finding work. They're having a tough time finding labor, and so they're having to pay more money to their workers, which means it's costing them more money to build a home, which means that now you're going to have to pay more money to buy a home. And so now builders are struggling because they're saying, well, a home that used to cost us $300,000 is costing us $350,000 or $360,000 now. And so instead of them selling this home for $350,000, they have to sell you the home for $425,000. And this is where they have to decide. Is it worth trying to sell this home for $425,000? Are people going to be able to afford it? And are people going to want it? Or should they just wait? And then the cherry on top was the massive amounts of demand because everybody wanted to go out and buy a home. First, people wanted to take advantage of these cheap mortgage rates, and then you had the people that wanted to upgrade or they wanted to downsize. They wanted to move out of the cities because this pandemic has changed the way that we work, because now a lot of people can work from home. And even if you can't work from home, people are quitting their jobs through something called the Great Resignation, and now they're moving to jobs which allow them to work from home. And so if you can work from home, you want a home that you want to work in and that you have an office in. So you had a lot of people moving out of the cities, moving into the suburbs, where now they can buy a home with an office that has a yard. And so you had a lot of people wanting new homes. So you had a massive demand of people wanting to buy homes, not that many homes available for sale, and very low mortgage rates, which was the perfect storm causing housing prices to go up. Now it's become pretty clear that a housing market is shifting, which is why you need to understand what's going on. And to go over that, I'm going to go over three things. First, I'm going to go over what's going on right now that we can get a good understanding of what's happening in the housing market. Second, we're going to go over why what's going on might not lead to exactly what you're expecting, but you do need to understand what could potentially be coming, which is what I'm going to go over in the third part of this video. So let's start with number one. What the heck is going on right now? But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. And if you are looking for some extra guac, we got some extra Minority Mindset channels that you can check out. We have the Minority Mindset news channel where Nate is publishing daily finance and business news videos every single day. We have the Minority Mindset clips channel where you can watch shorter Minority Mindset videos, somewhere between 8 to 12 minutes long. And then we have the Minority Mindset Spanish channel where you can watch our videos in Spanish. So if you want to check out these new YouTube channels, subscribe and start watching these videos. I'll put the link to where you can do that in the description below. Right now, we're starting to see the housing market cool down because we're seeing more homes being listed for sale, and we're seeing less and less people being interested to buy a home because either prices are too high or they've been outbid so many times that they're just wanting to take a break and they're waiting to see what's going to happen before they go out and try to actually buy a home again. Now, as a visual representation of what a housing market cool down means, because everybody thinks that a housing market cool down means this is what we've been seeing happen. We've been seeing this massive run up in housing prices, and we're going to see housing prices go down like this. This is a housing market crash. This is a housing market correction with home prices going down slowly, but again, less than a 20% drop is a correction. A housing price cool down means this. You're still seeing home prices grow, but just not growing as fast as it was before. We are still seeing home prices go up, but they're just not growing as fast as we saw happen in the middle of 2021 when home prices were growing at record-breaking speeds. You're seeing mortgage applications go down because less and less people are applying for mortgages because people are getting priced out of the market or they want to wait out the market. And then you're seeing more people list their homes for sale. So housing market prices depend on supply and demand. When you have a lot of people that want to buy a home and not that many sellers, this pushes home price up because now all the buyers are going to be fighting against each other to buy a home. Versus the opposite, when you have a lot of sellers and not that many buyers, now the sellers are fighting against each other by cutting their prices to get one of the buyers to buy their home. So what we saw happen in 2021 was we saw a massive amount of buyers and not that many sellers. This pushed home prices up. Now we're starting to see this kind of equalize because we're seeing less buyers and more sellers. We still have more buyers and sellers out there, but in general, compared to before, we have less buyers and more sellers, which is why home prices are not growing as fast. I invest in real estate, so I've been paying close attention to this, and what you've been seeing happen is a home that used to be worth, let's say, $300,000, what people saw is they would list their homes for sale for $300,000 or even $295,000, and then they would get bids up to $340,000. So then this $300,000 home would sell for $340,000. Then their neighbors would see a home on their street sell for $340,000, and they would get excited. They would say, "Whoa, maybe we should list our homes for sale too." So then their neighbors would list their home for sale at $335,000, even though it was only worth $300,000. And then they might have also been fortunate enough to see a bidding war, and then they sold their home for $350,000. And then their neighbor says, "Holy cow, their home just sold for $350,000. Let's list our home for $355,000. And this is what we're seeing happen right now. People are listing their homes for way more than what their homes were worth just a year ago. And now, because there are less buyers and more sellers out there, buyers are saying, you know what? I don't want to pay $355,000 for this home. And now the seller is saying, oh my God, what do we do? Let's cut the prices on our homes. So what you're finally starting to see happen is you are seeing people list their homes for sale, cut the price of their homes. You are seeing price decreases across the country in different neighborhoods. It's not massive decreases. It's not like we're seeing this, but you are seeing some price decreases because people are listing their homes and they're not getting as many offers as they would like, and they're not getting as many bidding wars as they would have liked to see. And so you're starting to see people list their homes at very high prices, and now they're starting to adjust their listing prices. One of the most apparent examples of this is Zillow. So Zillow, as we all know, is a website where you can go and see homes that are available for sale, see what their homes are worth, and see pictures of homes. Well, Zillow got into this business recently where they would find homes that they think they could kind of renovate, not major renovations, but do a little bit of, putting on some lipstick, doing a little bit of painting, a little bit of light work. That way they could flip the home for a higher price. So Zillow entered the home flipping business, which, as we all should know, it's a risky business. So Zillow entered this home flipping business. They were buying up homes across the country, buying up massive amounts of homes, thinking that they could just flip these homes for a big profit. And they were doing that, but now they've stopped this business completely because one, they're getting worried about the housing market, and second, they are now sitting on a massive inventory of homes that they're having a tough time selling. Homes are not selling for the prices that they thought they would. They thought the home prices would just continue going up, boom, like this. But we're seeing home prices slow down, and so they're not getting the prices that they want. They're starting to lose money on their homes. So they shut down this business, and now they're no longer buying new homes, and they're trying to liquidate this inventory of homes that they do have because they're getting worried about the economy, and they're seeing that home prices are not growing at the rate that they were before. We've also seen a major uptick in foreclosures because now that these moratoriums have ended, banks are now allowed to foreclose on homes and people that are not paying their mortgages. And what we're seeing happen, which is not a major surprise, that compared to before, you have a lot more people that are not paying their mortgages. So you've seen a big uptick in foreclosures by banks. Now, I want you to take this foreclosure information with a grain of salt though, because while all the media talks about how foreclosures are skyrocketing, compared compared to historic levels, the number of foreclosures that are happening are still historically very low. So compared to a year ago where you saw 0 foreclosures, you are seeing way more foreclosures now than before because, well, we are finally starting to see foreclosures. But compared to historical foreclosure data, we're still seeing historically very low amounts of foreclosures. So yes, we are seeing more foreclosures. Yes, it's a lot more now than before, but compared to prior to the pandemic, it's still lower than prior to the pandemic. So we're still seeing low amounts of foreclosures. It's just more than no foreclosures. And this is where you're starting to see a little bit of risky behavior because people have that fear of missing out. FOMO, because they see home prices going up, they want to buy a home, but they don't want to pay these higher mortgage rates now, even though mortgage rates now are still historically extremely low. They're just not as low as they were in the middle of 2021. But right now, mortgage rates are still historically extremely low. You can lock in a 30-year mortgage rate around 3%. And so, I mean, we're talking about historically super cheap mortgages, but some people are saying, you know what, I want to go and buy a home, but I cannot afford a 3% mortgage rate. So I want to do something where I can buy a home right now on today's prices, but try to get an even cheaper mortgage rate by doing something like getting a variable interest rate that has a 5-year teaser rate. So what we're seeing is we are starting to see a slight comeback with variable interest rate mortgages, those adjustable rate mortgages where for the first 5 years, you can get a very cheap teaser rate. Sometimes around 2%, maybe even less depending on what you get. And so now all of a sudden, you can even beat out a 3% 30-year fixed by getting a 2% rate for 5 years. Now, after those 5 years, your mortgage rate is going to readjust. And then based off of what happens with interest rates, where it looks like interest rates will go up, your mortgage payment will readjust. And if interest rates go up, which they probably will, your mortgage payments will also go up. But people are so focused on getting this first 5 years of low mortgage rates that now they're willing to go to these adjustable rate mortgages. Now, this isn't a massive push of adjustable rate mortgages now like we saw before the 2008 crash, but we are seeing more people go to these type of adjustable rate mortgages because they don't want to lock in a 30-year fixed. And instead of locking in a 3% mortgage rate, they're going in at a teaser rate of 2%. Look, I'm going to try to say this as clearly as possible. Adjustable rate mortgages are very, very risky. Yes, for the first 5 years, you can lock in a very low mortgage rate. But if you do not plan on paying off your mortgage within the first 5 years, within your teaser rate, now you're taking on a whole bunch of risk because right now, mortgage rates are at rock bottom. And when mortgage rates are at rock bottom, one of the only directions that they can go is up. Yes, we can see negative interest rates, but it looks like we are going to see interest rates go up. And so if interest rates go up, then what you can see happen is your 2% mortgage rate can go up to 4% or 5%. And then that means your monthly payment would double, maybe even more than double. So instead of just focusing on the first 5 years, I want you to be smart, buy a home that you can afford and lock in a 30-year or 15-year fixed because you are locking in these interest rates for 30 years. No matter what happens in the economy, you are locked in. And if we see interest rates go down even more, well, then you can always just refinance out to a cheaper mortgage. It does not make sense in this economic environment to take a risk with a variable or adjustable rate mortgage unless you are very, very, very certain, and I mean like 110% certain that you can pay off your mortgage in the first 5 years during that teaser rate. If there's any possibility that you will not be able to do that, do not get an adjustable rate mortgage and just lock in these historically cheap mortgage rates right now. That's the best piece of advice that I can give you when it comes to buying a home because everybody's asking, oh, should I wait for a crash? Should I wait for a correction? Or should I buy now? There's no way to predict what's going to happen tomorrow or next month or next year, but what you can do is if you want to buy a home, fine. Just make sure you can afford what you can buy. And if you can lock in your payments, then you don't got anything to worry about because now you know what your monthly costs are going to be even if you see an economic crash. And if interest rates do go down, you can just refinance to a cheaper mortgage rate. And ironically, as I was recording this video, talking about adjustable rate mortgages, I got an email from Ally Bank with the subject line, now you can get agile with an adjustable rate or stay steady with a fixed jumbo loan with the title, our jumbo loans can be fixed or flexible, talking about ARMs. And it says right here that, quote, ARMs are available. ARMs are adjustable rate mortgages. And what it says is that if you plan on moving or refinancing in 5, 7, or 10 years, and you want to pay less interest than you would with a fixed rate loan, consider the adjustable rate mortgage. I can't see anything wrong with that. I mean, it's not like nobody ever said this before the 2008 crash that, hey, don't worry, you can just refinance in 5 years because home prices only go up. The only problem is, what happens if they don't? So very interestingly, as I was talking about this, we got an email promoting it because banks are realizing that they need to give more incentives to give people a mortgage. So what are they doing? Promoting adjustable rate mortgages. In other words, do not stretch yourself too thin to buy a home, buy what you can afford. And when you're shopping around for your mortgages, make sure you actually shop around because some lenders are going to charge you a whole lot less in interest and fees than other lenders on the exact same loan and the exact same refinance. So make sure you shop around because they can save you a whole lot of money, and it's a lot easier now than before thanks to the internet because you can just use a mortgage comparison tool. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. With Credible, you can check pre-qualified mortgage or refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. The process is very simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and the Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to where you can do that with our sponsor Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to where you can do that with Credible in the description below. The reason why I say that everything going on right now might not lead to what you expect because a lot of people have jumped to the conclusion that we are about to see a repeat of 2008. But we are not going to see a repeat of 2008 because all the factors that we have going on right now are different. Now, this doesn't mean that we won't see a housing market crash at some point in our future, but you have to understand what's going on now because what we're seeing happen now is different than before 2008. This is not to say that we don't have any risk factors in the housing market. It's just that the risk factors that we have going on now are very different. And so when you try to compare now to 2008, it's going to look like two completely different things. And so people were going to say, oh, we're going to see this happen because they're just comparing it to 2008, but you're looking at the wrong factors. So if you want to understand the housing market, you have to look at the right factors. So let's start by understanding what happened in 2008 that we can understand what you need to look at right now. Before the 2008 crash, you had four things going on. You had 0% down payment loans, you had ninja loans, you had subprime mortgages, and you had the growth of variable interest rate mortgages. All four of these things came together to lead to the housing market slowdown. And then you had all the banks and institutions betting on the housing market and leveraging up their bets, which turned this housing market slowdown into an utter housing market collapse, which also led to the almost destruction of our financial system. So if we focus in on the consumer side, you had the growth of 0% down payment mortgages because everyone from the banks to the government thought that your home is an asset and home prices can only go up, and we wanted to make home ownership affordable for everybody in the United States. And what's an easier way to make home ownership more affordable than by making absolutely no barriers for you to go out to buy a home? And so now, if you wanted to go out and buy a home that was $300,000, you didn't need to bring 20% to the table. You didn't even need to bring 3% to the table. You can go to the table with 0% down, and sometimes banks would even give you more than 100% loan because then they would also cover your closing costs and your other fees. That way you literally didn't have to bring any money to the table. It was cheaper for you to go out and buy a home than it was to rent because when you rented a home, you had to at least bring your security deposit and your first month's rent to the table. With mortgages, you didn't even have to do that sometimes. You didn't need to pay any closing fees because banks were willing to cover all of it for you because they knew that home prices could only go up. We all know how that ended up. And then you had the growth of ninja loans. Ninja is an acronym that stood for no income, no job, no asset loans. So now, let's assume that you want to buy the same $300,000 home with no down payment, except you don't got a job. Don't worry about it. You don't need an income or assets to go out and get approved for a mortgage because home prices can only go up. And so now it was even more accessible for people to go out and buy a home because not only did you not need a down payment, but you could just get a ninja loan. Then we saw the growth of subprime mortgages. A subprime mortgage is a mortgage to somebody who does not have a good credit score. And so now what banks were seeing happen was some people couldn't get qualified to own a home because their credit score was not good enough. And that's where banks worked with other organizations and institutions and the government to come up with this program to allow you, somebody with a 500 credit score, to now go out and get a home with 0% down payment, even if you didn't have a great job, because everybody deserves to be a homeowner. So we saw the growth of now subprime mortgages, and you had a lot of subprime borrowers now borrowing insane amounts of money, even if they didn't have the best income, because homes are assets that only go up in value. And even if you couldn't afford your monthly payment at the current interest rates, well, that's when banks started coming up with things like variable interest rate mortgages with a short-term teaser rate. So now, if your mortgage payment would have been $1,500 a month, the bank would say, oh, don't worry about that. You can just get this variable interest rate mortgage, and instead of paying $1,500 a month for this big home, you just gotta pay $500 a month for the first few years, and then after the first few years, it will readjust. But don't worry, you can just refinance your mortgage then, or you can sell it then for a big profit, so you won't have anything to worry about. So now, you had 0% down payment mortgages, you had ninja loans, you had subprime mortgages, and you had the growth of these variable interest rate mortgages, which meant that now you had a lot of banks lending money to people who probably shouldn't be qualifying to buy a home. These four different factors came together to cause a huge run-up in housing prices, and then when housing prices went a little bit too high and home prices started to go down, that's when people started to go underwater on their homes because they didn't have any skin in the game. So now when your mortgage payment started to go up because your teaser rate expired, you couldn't refinance because now you're underwater, and you couldn't sell because you'd have to bring $20,000 to the closing table, and chances are you didn't have $20,000. So you started to see home prices go down, and now people started to get foreclosed on, and this is what triggered now everything going on Wall Street, because banks thought that home prices will only go up. And so not only were they lending out this money and making all these risky mortgages, but then they started gambling with these mortgages on the back end. They started chopping up their mortgages, packaging them up into new investments, selling them again and again and again, buying up insurance on these investments because then the insurance companies wanted to get involved. So it became this whole big derivative mess on the back end. So now this housing market slowdown became 100 times worse because of everything that the banks and the institutions on Wall Street were doing on the back end. So this is why when you saw the housing market go down, you saw the entire financial system almost go down with it. In our real estate market today, we have very different risk factors and different things going on than before the 2008 crash. We are not seeing these type of levels of risky loans. We are not seeing the same growth of adjustable rate mortgages that we saw before the 2008 crash. We're not seeing ninja loans like we saw before the 2008 crash. So the risk factors on the consumer side are very different. And what you're seeing happen is that some people are listing their homes for sale, and they're getting an accepted offer at a very high price, and then banks are not even appraising the home. You might get your home approved for $350,000. Somebody might be willing to pay $350,000 for your home, but then the bank might come and say that your home's only worth $300,000, so they might not be willing to lend money to the buyer. So what we're seeing happen on the consumer side is very different. Are there still risk factors on the consumer side? Sure. You still have very low down payment mortgages, so if we saw home prices correct, you would still see people that are underwater. You're still seeing banks make some risky loans. You're seeing the growth slowly of these types of adjustable rate mortgages. But again, compared to what we saw before the 2008 crash, it is not comparable. However, Wall Street has not learned their lesson. We're seeing more derivatives in the financial markets now than we saw before the 2008 crash. We actually have many multiples more of derivatives now than before the 2008 crash because we have so many industries just in the business of moving money from one place to another rather than actually producing anything. So you have so many institutions on Wall Street that are just getting paid to move money from one company to another company. And so all they're doing is just moving money from one hand to another, and they're taking fees by doing that as opposed to actually producing any real value. And another big difference between now and before 2008 is we have way more economic differences than before 2008. Before 2008, I mean, if you looked at the real estate market in a bubble, you saw all the concerns within the real estate market. Now, if we just look at the real estate market in a bubble, you don't see those same concerns. But if we step outside of the real estate market bubble and we look at the economy on a broader scale, That's where you start to see the issues now that you didn't see before the 2008 crash. Because right now, we have a lot of cheap money floating around. We saw a historic amount of money being printed in 2020 and 2021 to stimulate the economy. We're already at historically low interest rates. We didn't see that before the 2008 crash. After the 2008 crash, we saw a historic amount of money printing happen, which created massive amounts of inflation. Well, right now, we have already printed more money than before 2008. We've only begun to see the inflationary effects of all this money printing from 2020 and 2021 in the economy, and our economy is not growing fast enough. The reality is you cannot sustainably grow an economy by stimulating, by printing cheap money, and by artificially low interest rates. You cannot grow an economy sustainably with this type of just artificial stimulation. The way you actually grow an economy is by production, by innovation, and by creativity. We're lacking in this, but the government and the Federal Reserve Bank believe that we can grow our economy and stay a world powerful force by just stimulating our economy with cheap money. Now, this can cause a short-term boom in the economy, but we pay the price for that through more inflation, because anytime we print more money, this causes more inflation. And so the issue now is what's going to happen to the long-term health of our economy and our dollar. People are concerned about what's going to happen to our dollar with all the money printing that we've seen happen, through all the money printing that we will continue to see happen, through all of this government spending that we're seeing. And what happens is you're going to see the value of the dollar go down. And if people start to lose faith in the value of the dollar, well, then that's going to cause a major crisis in our economic system. And if we start to see a slowdown in the economic system, well, that means that people are no longer going to have their same amount of jobs as they have now. And if people don't have jobs, they're not going to have a paycheck. And if they don't have a paycheck, well, then now they're not going to have money to pay their mortgages. And if they don't have money to pay their mortgages, well, you get the idea. So the concern right now isn't just what's going on in the real estate market. The concern right now is what's going on in the economy. This is why we've been talking so much about economic issues in our country and in our economy right now, because we are facing real inflationary pressures that we haven't seen the end of yet. Which brings me to the question, what are we going to see happen? And the way that you answer that question is going to depend on what we do as a country, as an economy, because right now we are facing real pressures on our economy and on the dollar. Now, my goal is never to tell you what to think or what to believe. My goal is to help you be financially educated. That way you can make smarter decisions with your money by understanding what's going on and by understanding financial education. But right now we are in a society and in an environment where the Federal Reserve Bank and the government don't believe that more money printing will cause more inflation. In fact, they believe the opposite. They believe that inflation is being caused because we have a strong economy, and due to our strengthening economy, we are seeing these inflationary pressures because our economy is too strong. Now look, I know, I'm just a random guy on YouTube, but I have a hard time believing that. The reason why the government and the Federal Reserve Bank are having such a hard time slowing down inflation is because they know that if they slow down the money printer, they raise interest rates, it's going to deeply slow down the economy. I mean, anytime you hear the government and the Fed talk about raising mortgage rates, people get scared. People stop buying homes. Businesses stop borrowing money, and the economy slows down. We've seen this happen multiple times. As interest rates slowly went up, they went right back down because the Federal Reserve Bank and the government see that our economy right now is needing these low mortgage rates in order to continue surviving, because they need this type of stimulus. They need this cheap money in order to keep producing. So right now what we're seeing happen is kind of a race between, you can just compare it to national debt and GDP. National debt is the amount of money that the government spends that they don't have, compared to GDP, which is the size of our economy. The government's hoping that if we just raise the national debt, we'll be able to raise the GDP. Right now, our GDP, our economy is losing. So the government is trying to just raise the national debt even more, borrow more money, more cheap interest rates, and this will help, boom, grow the GDP. Now, again, I can't predict the future. Maybe it will work, maybe it won't. But what you need to understand is that our economy is still on shaky waters. We are not out of the water yet. We have a lot of factors that we need to pay attention to the economy to understand what's really going on. Because if we see another slowdown in the economy in, let's say, 2022 or 2023, it is going to be very hard now for the Federal Reserve Bank to now stimulate again to get us out of this next economic mess. So if we see another economic slowdown in the next 5 years, well, then it's going to be very hard now for our economy to stimulate ourselves out of the next economic mess, which means that we could potentially see a more painful and a longer economic struggle come if we see another economic slowdown. But again, just big ifs. If we don't see an economic slowdown and this works and our economy can start to grow much faster, people start to go back to work and our economy can start to boom faster than a national debt, and now because we're making so much money as an economy, the government's making more money and we start paying down our national debt, then there's nothing to worry about. But if we don't see that, then you do have concerns. And so, I can't predict the future. I'm not trying to tell you what is going to happen, but these are the factors that you need to pay attention to, that we can understand what will happen not just in the housing market, but in the economy, because that will help dictate what happens in the housing market and every other asset class. If you enjoyed what you saw so far, then you're gonna love this. Buying a home is exciting and it's a big deal, but the process isn't always straightforward. You gotta deal with real estate agents, bankers, title companies, property inspectors, and because homes are so expensive, if you don't know what you're doing, you could end up way overpaying. I've seen real estate from a lot of different angles because I used to be a real estate agent, I'm a real estate investor, and I'm an attorney. But in this video, I wanna go over the things you need to understand about getting a mortgage. If you wanna buy a $400,000 home, chances are you don't got 400 grand just sitting at the bank that you can use to buy the home, so you're gonna work at the bank to get a mortgage, that way you can actually buy the home, but you wanna make sure you're not getting taken advantage of by your bank. Before you go out and actually start looking at homes and making an offer, the first thing you wanna do is get pre-qualified and get prepared to actually getting a mortgage. All getting pre-qualified means is that you've worked with a lender or a banker to get the basic credit process done, that way the bank or lender can see if they're willing to give you a loan. If you're not pre-qualified, you don't look like a serious buyer, because I can tell you from personal experience, it is a major headache working with somebody who's not pre-qualified, because if you fall in love with a home and you put an offer and it gets accepted, and now you have to kind of get pre-qualified and get approved to get a mortgage, and you can't do that, it is a major hassle because now you're wasting your time, you're wasting your real estate agent's time, and you're wasting the seller's time. I was selling an apartment complex that I was a part owner of, and a lady brought an offer to me. The problem was she was not pre-qualified, but she gave me a pretty good offer. Now, the real estate agent I was working with kept saying, oh, don't worry, Jaspreet, she has a lot of money, she's really successful, she'll have no problem getting a loan. So I thought, okay, fine, I'll let this one go. So now we're in contract, I take my property off market, and a month goes by, she couldn't get approved for a loan. 2 months go by, she couldn't get approved for a loan. 4 months go by and she could not get approved for a loan. At this point, we had to cancel the deal, and I had taken the property off market for 4 months, and it was just a huge waste of time on my part, on my real estate agent's part, and her part. As soon as you get pre-qualified, you automatically have an edge over other buyers who are not pre-qualified, because if I'm selling a home and I get 2 offers, one is from somebody who's pre-qualified and one is from somebody who's not pre-qualified, and you're pre-qualified and your offer is slightly lower than this person's, I'm still gonna take your offer even though it's less money, because it's less headache and less uncertainty because you've already gotten pre-qualified. Part of the pre-qualification process is you getting prepared to actually get a mortgage, because, well, getting a mortgage is kind of a difficult process. You're essentially kind of selling yourself to the bank, and you want to show the bank why you're a good investment for their money, because if you can show the bank that you're a good investment, they will reward you with a lower interest rate. First, you got to show the bank your proof of income. So you might need to show your tax returns, your W-2s, your 1099s, whatever income that you have, at least for 2 years steadily. You need to show this to the bank, that way the bank can see that you're making money consistently. Second, you want to show the bank any assets you might have. So maybe you own some real estate investments or stock market investments or other assets. You want to show this to the bank so you can show the bank what you have. Third, the bank is going to want to know what debt you have and how much debt you have. Your debt to income ratio is literally just a fraction, where banks look at how much debt you're making and they divide it by your income. So nowadays, banks typically like to see a debt to income ratio of less than 36%. So they want to see that your debt is less than 36% of your income, and out of this 36%, they typically don't want to see more than 28% for your mortgage. So this is how much your mortgage should be max, and the rest of it can be your credit card debt, your car loans, or whatever. This is how much banks ideally want to see, but sometimes you'll see banks stretch this total debt to income ratio from 36% up to 43%. So if you have a lot of outstanding debt, credit card debt, car loans, it's going to be harder for you to qualify for a mortgage. So you need to work right now to pay down that debt. That way you can lower your debt to income ratio. The fifth thing your bank or lender is going to look at is your credit score. You can get approved for a mortgage with a credit score of 620 or higher, but if you have a 620 credit score, score, you're going to have to pay a lot more fees and a lot higher interest rate because the bank's going to look at you like a riskier investment. If you want to get the best interest rates and not pay these extra fees, you want to have a credit score of at least 760 or above. If you're looking for ways to boost your credit score, you can use a credit card strategically and you can work to pay your bills on time. The second thing you need to understand about mortgages are the different kinds of mortgages out there, because not all mortgages are created the same. First, let's talk about the differences between a fixed rate mortgage and an adjustable rate mortgage, an ARM. So fixed rate mortgages are very straightforward. If you go to the bank and tell them you want a loan, they might say, all right, this mortgage is going to cost you 2.8% a year, and if you agree to that, for the next 30 years, you're going to be paying 2.8% a year in interest on your mortgage, and that's it. It's not going to change. Whether interest rates go up or down, this is the interest rate you are going to pay, and you have a set monthly payment. With an adjustable rate mortgage, it's not like that. With an ARM, the amount of money you're going to pay on your mortgage is going to change depending on what interest rates are. So one type of ARM that became very popular during the 2008 crash was the 228 ARM. What that means is during the first 2 years of your mortgage, you're going to have a very low introductory teaser interest rate. So during the first 2 years, your monthly mortgage payments are very low. Then after that, your interest rate is going to change every 2 years depending on what interest rates are. So if interest rates go up, then your mortgage payments are going to go up, and that's going to change every 2 years for the next 30 years. So you don't know what your mortgage payment is going to look like in 5 years or 10 years because you don't know what interest rates are going to be. If interest rates go up, your mortgage payments can go up. Another example of this is the 5-to-1 ARM. What this means is during the first 5 years of your mortgage, your interest rate is fixed, and then every 1 year after that, your mortgage rate is going to change depending on what interest rates are. And then the 5-by-5 ARM says that during the first 5 years of your mortgage, your interest rate is not going to change, but then every 5 years after that, your interest rate is going to change depending on what interest rates are. ARMs can be good when you're in an interest rate environment where you think interest rates are going to go down. But right now, we are in one of the lowest interest rate periods in history. It doesn't make sense to get an ARM when interest rates are already lower than they've ever been. In the future, the only way interest rates can go are up unless we go negative interest rates. But even then, we're already seeing the lowest interest rates in history, and we saw what happens if you tie yourself into an ARM and then interest rates go up, because that's exactly what happened in the 2008 crash. Everybody was getting into these 228 ARMs thinking that they were getting this amazing low teaser rate for the first couple of years, and then real estate prices came down and people couldn't refinance, and now everybody's mortgage payments were way higher than they anticipated, so people started foreclosing left and right. So ARMs can be good, hypothetically, when you're in an interest rate environment where interest rates are going down, but they come with their own fair share of risk. You can mitigate that risk just by getting a low fixed rate mortgage, and now you know exactly what your mortgage payments are going to be for the entire length of your mortgage. You have two main categories of mortgages. You have conventional mortgages, and then you have government mortgages. Government mortgages is money coming from the government, and conventional mortgages are not. That's the main difference. But the way these different types of mortgages play out is a little bit different when it comes to your down payment and how high your interest rate is going to be, so you really want to understand the differences. So starting with the conventional mortgage, you have a couple different kinds. You have conforming mortgages, and then you have non-conforming mortgages. All the difference is how big your mortgage is. Fannie Mae and Freddie Mac set what the limit is for a conforming mortgage, and if you get a mortgage that's bigger than that, it's called a non-conforming mortgage, and then you need something called a jumbo loan. So the difference between these two types of mortgages is really just how big your mortgage is. In 2021, the limit for a conforming mortgage is right around $550,000 for your mortgage, unless you're in a really big city like New York, where now your mortgage limit is a little bit higher. But if you get a mortgage that's smaller than that, you will get a conforming mortgage. If you need a mortgage that's bigger than that, then you're going to need a non-conforming jumbo loan. If you qualify for a conventional conforming mortgage, then you can get a home with a down payment as small as 3%. Now, if you put down 3%, you're going to have to pay additional fees like PMI, which is private mortgage insurance, where you're essentially buying insurance for the bank just in case you foreclose. But just understand that you can buy a home with a low down payment. However, it's going to cost you a little bit more in fees. With a non-conforming mortgage, so if you're getting a larger loan, a jumbo loan, then you're not going to typically get a down payment that's as small as 3%. You're going to have to pay a larger down payment because the bank is risking more money on you. So they're going to want you to put more skin in the game. Once you have 20% equity in your home, or if you put down 20% equity when you buy the home, then you can wipe out PMI. So until you have 20% equity in your home, you're going to be paying that additional fee called PMI with a conventional mortgage. And the advantage with a conventional mortgage over government-based mortgages is typically you get a lower interest rate here because you have a higher credit score requirement. So it's a little bit more difficult to qualify for a conventional mortgage than it is for a government mortgage. Now, moving on to government mortgages, the first type of mortgage is the FHA mortgage. So FHA is the Federal Housing Association, and the whole point of these FHA mortgages is to help people qualify for a home and mortgage who don't have the best credit score and who might not be able to put down a lot of money as a down payment. So to qualify for an FHA mortgage, you need to only have 3.5% as a down payment, and you can qualify for an FHA mortgage in some instances with a credit score lower than 620. Now, the downfall with this is FHA mortgages come with higher interest rates and higher fees. So because lenders will kind of look at you more as a risky investment, you're going to have to pay the price. And so one thing you're going to have to do is you're going to have to pay an upfront insurance fee when you get an FHA mortgage. And then you're going to have to pay an insurance fee on the back end for the life of your mortgage. So it's not PMI like you have to pay here. It's a different type of insurance, but you have to pay this additional fee in addition to your regular mortgage payments just because you're getting an FHA mortgage. The difference between the insurance fee that you have to pay with an FHA mortgage every single month and this PMI that you have to pay here if you don't have 20% in equity in your home is once you have 20% equity in your home with an FHA mortgage, you have to keep paying that fee. So this fee doesn't go away once you have 20% equity versus PMI goes away here once you have 20% equity. So the whole idea is these government mortgages can help you get a home, and then once you can qualify for a conventional mortgage, you can refinance out here and get one of these. That way you can pay a lower interest rate and pay less in fees. Second is the USDA, United States Department of Agriculture loans. These are more for rural homes. This is for people who are lower income or moderate income. This allows you to buy a home with 0% down payment in certain instances. So you can buy a home with nothing down, but again, you got to pay higher fees. You're going to have to pay another insurance fee with your mortgage here, and that does not go away once you have 20% equity. So once you have 20% equity, it might make sense for you to refinance and get another loan here, depending on what interest rates are. And third are your VA loans. This is for military personnel and people who were in the military. So VA loans let you qualify for mortgages with 0% down, and these can be typically lower interest rate mortgages. However, because you're getting a lower interest rate and because you're putting 0% down, you have to pay a higher upfront fee here, an insurance fee with the VA mortgage, than you see here or here. So to qualify for a VA mortgage, you have to be a part of the military or have been a part of the military, and then you have to pay that additional fee in the beginning. But with the VA loan, unlike FHA and USDA, you don't have the ongoing insurance fee. So these government mortgages can help you qualify for a home, but with an FHA and USDA mortgage, you might have to pay higher fees during the life of your mortgage. So it might make sense for you to then refinance into a conventional mortgage, again depending on what interest rates are when you're looking at refinancing, because then you can save some money on your interest rate mortgage and you might not have to pay some of these insurance fees. Third, you got to understand what changes your mortgage rates. There are 5 big factors that affect your interest rates, and we've gone over 4 of them. So one of them is whether you're getting a fixed rate or an adjustable rate mortgage. Second is what interest rates are. These are set by the Federal Reserve Bank. Third is how much your credit score is. Fourth is how much money you're putting down. And fifth is how long your mortgage is. To understand this, you really got to look at it from the perspective of the bank. So banks have all this money, and when they loan this money out, it is an investment for the bank. So the riskier the investment is for the bank, the more money they're going to want to see as a return. So if you're asking for a risky loan, the bank is going to want to charge you more money. And one of the ways to qualify a riskier investment is how long you want to borrow the money for. The longer the bank has to go without their money, the riskier the investment is. And so when you compare a 15-year mortgage with a 30-year mortgage, a 30-year mortgage is going to seem a little bit riskier for the bank because their money is going to be with you for 30 years. And so the bank is going to charge you a little bit higher in interest. With a 15-year mortgage, the bank is going to get their money back in 15 years, not 30 years. And so they can charge you a little bit less in interest because it's less risky for the bank. This is where you have to make more of a personal financial decision, because when you get a 30-year mortgage, you can buy a bigger home and have a smaller monthly payment because your payments are extended over 30 years instead of just over 15 years. So if you look at the same mortgage over 30 years or 15 years, your 15-year mortgage is going to have a lower interest rate, but your monthly payments are going to be higher because you have to pay the mortgage off within 15 years. If you extend it over 30 years, your monthly payment is naturally going to be smaller, so you can qualify for more home. One thing that you can also do to help you with your mortgage rate is just shop around. It's crazy how many people don't do this. They just go to the bank that they normally go to for their mortgage without shopping around. Some lenders are going to charge you a whole lot less in interest for the exact same same mortgage. So it is in your best interest to shop around and make sure you're getting the lowest interest rate on your mortgage. There's really no excuse not to shop around anymore because you can shop around on the internet for your mortgage and it only takes a few minutes. If you want to learn more about how to do that, our team put together an amazing guide that walks you through how to get the best interest rate on your mortgage or refinance. So if you want to learn more about how to do that, I will link the article for you in the description below. Fourth, when it comes to getting a mortgage, it is your job to know what you can afford. It is not your real estate agent's job and it is not your bank's job. Your real estate agent's job is in the business of selling you a home. Your banker's job is in the business of selling you a mortgage. It is in both of these parties' best interest to give you the best home, which is typically the biggest home, which is also the home that's going to give these two parties the biggest commission check. Now, your job is to know what you can afford for your wallet. Just because you can qualify for $1 million home doesn't mean that you can afford it, and it doesn't mean that you should buy it. It's funny, every time I say this, I get these kind of angry messages from bankers or real estate people because I'm telling you to buy what you can afford, not buy what you can qualify for, and so that's not good news for the real estate agent or the banker. But let me show you what I mean. When it comes to affording a home, there's two things you have to look at. You have to look at the down payment and then the monthly payment. Your real estate agent and your banker's job is to get you into the home. So they're going to do whatever they can and pull whatever strings they can to get you into a home, even if you can't necessarily afford it. So when it comes to the down payment, a lot of times they're going to try to push you into a home with 0 to 5% down. That way you can get into that home of your dreams. Now, just because you can get into a home with 0% down or 5% down does not mean that you can afford it. If you really want to be able to afford your home, you want to be putting down 20%. Now, I know that's a lot of money. You want to buy a $300,000 home, that's $60,000 in cash you got to put down. But if you really want to be able to afford a home, you need to be putting down 20%. When you put down 20%, now you don't have to pay the higher fees, you don't have to pay the higher interest rates, and you have more equity in your home. When it comes to your mortgage payment, your monthly payment, your bank is going to say that they want your monthly payment to be something like 28% of your gross take-home pay. So this is before taxes. So if you take your total take-home pay before taxes, 28% of that should be your mortgage. I don't want you to pay that much money towards your mortgage because then on top of that, you got to pay your taxes, you got to pay all of your other bills, your utility bills, your car payments, everything else. I don't want you to do that. So what I want you to do is I want your monthly payment to be 25% of your actual take-home pay. So you take the money you're making, you pay your taxes, and now out of what's left, 1/4 should be the maximum of how much you're paying towards your mortgage. When you do that, you will leave enough money for your savings and for your investments. That way you can work to build yourself wealth instead of having all of your money going into the bank to make the bank rich. I want you to use your money to make yourself rich by paying a maximum of 25% of your take-home pay to your bank and then using as much as you can to invest and save in your own wealth. Now, I know this might mean you might have to work a little bit harder to own a home, you might have to buy a little bit smaller home, and you might have to save more money for your down payment. But you are going to sleep a whole lot easier knowing you're not stretching yourself too thin to buy this dream home that you can't even afford. Now, you're using your money the right way, that way you can make yourself rich instead of just your banker richer. The fifth thing that you have to understand when it comes to getting a mortgage is you might potentially want to refinance out of your mortgage in the future. So I mentioned this a little bit earlier in this video. If you get a government mortgage, you might have to pay a little bit higher interest rates and you might have to pay additional insurance on your mortgage. Now, if interest rates come down and you build more equity in your home, you could use this as an opportunity to refinance into a lower interest rate mortgage and to get rid of some of these fees. That way now you have the home that you're still living in and all you see happen is your monthly payments drop because you have a better mortgage now. The thing that I want to remind you here, that in order to refinance your mortgage, you need to see property values stay the same or go up. But real estate prices don't always go up. So you want to keep that in mind. Because people who were buying homes in the early 2000s, they were buying homes with these low teaser rates, thinking that when interest rates go up, they'll just be able to refinance their mortgage and then get these lower interest rates. The problem was that home prices dropped. So when people went to refinance their mortgages, turns out they couldn't qualify for a new refinance because they didn't have any equity in the homes because their home values dropped. So yeah, refinancing can be a great tool if you can refinance into a lower interest rate mortgage. But you don't want to go into a home thinking, yeah, you know what, I'll make the sacrifice now. That way in 5 years, I can refinance into a better mortgage. You don't want to do that because there's no way to predict what the world or what the real estate market or what the housing market is going to look like in 5 years. You don't want to be in that position that people were in back in 2008 and 2009. But what I'm trying to say is this is why it's so important for you to be able to afford the home that you're buying right now, because you don't want to run in a situation where 5-10 years down the road, home prices drop or you can't refinance because you thought you were going to be able to, and now you're stuck in a home that you cannot afford. Make sure you can afford the home today and not kind of rely on the stars to align in the future so you can afford the home. Thank you for watching. If you enjoyed this video, here's a video of things you need to be aware of before you buy a home that I think you'll love. And while I edit, download a free guide on how to start generating passive income. And as always, keep hustling. 4 months go by and she could not get approved for a loan. At this point, we had to cancel the deal and I had taken the property off market for 4 months, and it was just a huge waste of time on my part, on my real estate agent's part, and her part.